So we know a lot of folks taking off ahead of the extended weekend, but a lot going on today, right? We got the Fed minutes coming out just seconds ago. There's a bevy of economic data this morning. Now, on the good side, you had durable goods came in much better than expected, especially business investments, really something of a surprise. New home sales, this continues to boggle the mind. I'll ask Daniel DiMartino Booth about that. Consumer sentiment trending higher, although there's some hair on this number too. What should we be worried about? The so-called flash PMI, the U.S. manufacturing and service economy starting to really break down in initial jobless claims. I hate to tell you, folks, the Federal Reserve wants fewer people in this country to be employed. Looks like that's beginning to happen. Having said that, as an investor, I always want business investments to go through the roof. I think that's a good sign. So we'll see what happens there. You can also see, while we have these investments doing pretty well, this is shipping and new orders. The month before were down, so they kind of negate one another. Still, Wall Street thinks that might be too much strength for the Fed. Of course, the market seems to be following all of this stuff, but nothing seems to matter more. And I just mentioned it a moment ago, and that's jobs, the jobs picture. Starting to trend higher. You remember these initial jobless claims are coming in lower and lower every week? That's not happening anymore, right? 240,000. The street was looking for 225,000, so that's worse than expected. Meanwhile, the last 3 months has seen major rotation. You've seen this also perhaps even in your own portfolio. Some of the stocks you left for dead, these old economy stocks doing pretty well. The older, the hot names really aren't doing as well. So energy, of course, has had a great year. But look at this, materials. This is the last 3 months. Materials, financials, industrials. These are the kind of things you can touch and feel, right? So the question for you, should you be making adjustments in your portfolio that reflect this? I want to bring in now Bulltick Capital Markets Chief Strategist Kathryn Rooney Vera, along with Advisor Group Chief Market Strategist Phil Blancato. Phil, you're always pretty active in making these changes, which I love. So here I've got sort of an equity style box, and I want you to work with me because on one hand, we got large, medium, and small cap stocks, value, a blend of both, or growth. In this sort of scenario, where are you focused right now?
I'm in the upper left corner. I want to have the majority of my equities in value, traditional, as you said, things you can touch and feel.
Right.
I'm willing to go down in cap into mid caps that own regional banks and just have a hint into growth. So you want to be in the upper left quadrant, maybe down halfway through if you want to take a little more risk on. That's how you win, by getting a dividend, things that we need right now, being where the consumer's spending money, leisure, tourism, and manufacturing, energy, financials, a leadership change. You get your dividend, you're in the value sector. That's what does well in a slowing economy. That's how you win right now.
What about on the growth side? Nothing on growth?
I have a very small blend of growth. So I'm not in the pure growth stocks.
Okay.
I'm more so in the Apples, the Microsofts, and to a lesser degree, some of the crowd strikes in there as well. But I'm not willing to bet. When rates are pushing higher, those stocks get punched.
All right, so large cap growth, but mostly value. That's where you're focused. All right, KRV, I know you're very conscious of this kind of thing. How are you spreading your risk around right now in the equity market?
There's a time and a place for everything, Charles. And this year was the stagflation trade. That is, as you and I discussed coming into this year, defensives, value, energy, utilities, staples, and healthcare. And those are the sectors that typically outperform, not just in stagflation, but in recession. That said, as I started, there's a time and a place for everything. So 2023, I think we're going to get that point where we pile into, as Phil called it, those names, those cyclicals, those interest rate sensitive sectors that have been demolished.
Right.
I'm talking about technology, consumer discretionary. When do we get there? We can get there when we're mired in recession, when we're in recession, when unemployment's at 5% and the Fed starts cutting, which I think comes by the end of next year.
Oh, boy. Okay, so we start off here. We're safe, we're comfortable, but eventually it sounds like we'll end up back there. Let me go back to you then, Phil. With respect to all of the things that are going on, we're sort of, we're going through the FOMC minutes at this moment. Ed Lawrence is going to join us in a moment. Santa Claus rally, we're starting to look past that to 2023. What's out there that really worries you the most? I feel like we know all the known knowns are out there, and I don't know that there's anything that we don't know. It's just the nuance of what we know.
No, there's a really important one. I completely agree with the sentiment. Let's go from value to growth when the Fed stops hiking. Be late, not early. But the one thing I'm really worried about, it's clear. If the consumer runs out of money before the Fed stops hiking and breaks the back of inflation, we're going to be in a very deep recession. So right now, the consumer's holding on. They'll hold on to September of next year. We've got to get the ship righted by September next year. Otherwise, everything changes. For now, I'm comfortable. I'm long equities. I'm aggressive on stocks. I'm enjoying the rally. But I'm circling September because that's when the consumer runs out of that excess savings that we've had. And that's the big time of the year that we've got to be very careful and keep a close eye on it in next year.
You know, Kathryn, more recently, we're seeing some of these estimates on the street, like the CME Fed Watch, for instance, sort of pointing to the Fed making a mistake sooner rather than later, somewhere halfway through the year actually cutting rates. But you don't see that. It sounds like you think, okay, we'll end the year at about a 5% terminal rate.
The Fed's mistake occurred more than a year ago. So future mistakes have to correct the past mistake, which is keeping monetary policy so accommodative way past the expiration date. Let's remember that the Fed in March of this year was still buying bonds. So now they're finally rolling off the balance sheet and taking rates higher to combat inflation. I think it's all about the labor market. Once we get the unemployment rate up, we're going to be in recession, and the Fed is going to have finally approached its 2% target. We're still at 7.5%, above 7.5%. But I do think that by the end of next year, the Fed's going to move. What we have to also consider, Charles, is the balance sheet.
Right.
What are they going to do with that?
Right. That's always been a big question. I don't think they'll ever get it down to where they say they'll get it down. They certainly didn't last time. Kathryn, Phil, have a great Thanksgiving. Thank you both very much. Appreciate it.
Thank you.